Hi, welcome to the 52nd session on the liquidation process under IBC. Specifically, we are covering about the regulations prescribed by IBBI for liquidation process. So let's quickly recap what we have done in the previous session. In the previous session, we have covered regulations 16 to 25, which is mostly focused on how to make claims and the forms related to the claims. After that, the proving of the security interest, which is regulation 21. Then 22 we have read, it is dealing with the bills of exchange and promissory notes. 23 talks about how do you substantiate the claims, we have read that. 24 talks about cost of the proof, we said it is borne by the claimant himself in the case of cost of claim, but in the case of cost of verification it will be reimbursed to the liquidator as a liquidation cost. And the last and the regulation is regulation 25 that deals with determination of quantum of claim, and we said wherever the party is aggrieved by the decision of the liquidator, they can approach an adjudicatory authority and take an appropriate relief. So today's session we will focus on the next few regulations and try to understand what is IBBI saying about certain actions under liquidation. Regulation 26 specifically talks now about if the debt is in foreign currency, how do you deal with this? We need to understand the problem. The problem is simple. In case of a foreign currency debt, the exchange rate between Indian rupee and the foreign currency will keep on fluctuating on a day-to-day basis. And from the start of the CIRP to the start of the liquidation, there can be enormous amount of variation in terms of the exchange price. In that case, how do you deal with the exchange rate fluctuation, especially when the debt is actually measured in a foreign currency? So let's see how the regulations deal with this scenario. If a creditor's debt is denominated in a foreign currency, it must be converted to INR using the RBI exchange rate prevailing on the date of commencement of liquidation process. See, if you're taking, for example, an American dollar on the date of the debt, when the corporate debtor borrowed the debt, the exchange rate could be 50 rupees per $1. Whereas at the beginning of the CIRP, the exchange rate could have become 75 rupees per $1. But now, after the CIRP is concluded and the liquidation process is beginning, on this date, the exchange rate is 90 rupees per dollar. And maybe by the time the claim is submitted and it is admitted by the liquidator, it becomes 100 rupees per dollar. In that case, what should be the final exchange rate that we should apply so that we determine the debt in Indian currency, because it is denominated in a foreign currency? So the date on which the exchange rate should be considered, that date is actually pivotal in this regulation. So accordingly, regulation 26 says that please consider only the exchange rate determined by the RBI on the date of commencement of the liquidation process, but not any other date. So this is a crystal clear provision as to how the liquidator should consider the exchange rate. Then the second paragraph says the amount of debt in foreign currency once converted into INR is considered for determining the quantum of the claim in the liquidation process. So until it is converted, that is very important as to what is the exchange rate. Once it is converted, now for all future correspondences and also discussions and computations, the debt calculated, denominated in Indian currency will now prevail for all future transactions. Third paragraph further says that if there are any changes in the exchange rate between the date of liquidation and the date of final distribution, the liquidator may have to adjust the amount accordingly. So if the exchange rate increases on the actual date of determination, then maybe the liquidator is required to pay little more to equate or consider that exchange rate fluctuation at the last moment. Or accordingly, if the exchange rate falls down, then the liquidator may have to pay less to the creditor. Okay, let's move to Regulation 27, which speaks about periodical payments. If the liquidation process involves debts that require periodical payments, the liquidator is required to decide for these payments as per the terms of the debt. The liquidator must ensure that such payments are adjusted against the creditor's claim amount and follow the applicable terms and conditions. This is an important provision. So, if a certain debt requires periodical payments such as quarterly payments, half-yearly payments or monthly payments to be made by the corporate debtor to the creditor, then the liquidator shall consider these payments accordingly, and if there is any amount to be received by the corporate debtor from such creditor, then there should be mutual adjustments made, and only the final amount payable by the corporate debtor to the creditor shall be considered and may be paid on such quarterly installments or monthly installments, or can be summed up and paid at the time of distribution of the liquidation proceeds. The next paragraph says that regulation ensures that any debts requiring periodical payments are managed and distributed correctly by the liquidator during the liquidation process. Now we move on to Regulation 28 that talks about debt payable at a future time. If a debt is due to be paid at a future date, its present value must be determined for the purpose of liquidation proceedings. Those who have already come through commerce background and studied little about financial management will invariably know what is the present value of a future earning. But those who are not aware of this concept, let me explain you. There is a present value philosophy in the financial management. What it says is, if I have to pay 100 rupees to my friend at the end of 3 years, how much do I arrange today so that I pay him 100 rupees at the end of 3 years? So understand the point that if 100 rupees is the value of my payment at the end of 3 years, its value can be substantially less today. Right? Only then it will become a certain amount on the other day. Similarly, future value of a present earning can be entirely different. This all depends on the purchase power of the rupee on a certain date. Let's say today I have 1000 rupees in my hand and I can buy 30 kgs of rice with the help of this 1000 rupees today. But at the end of 3 years, maybe with the same 1000 rupees, I can buy only 20 kilos of rice. So therefore you are seeing that the rupee value is depreciating as the time progresses. Therefore, two different concepts: present value of a future earning and future value of a present earning. All this will depend on the purchase power of the money. So I have explained you that. Now, if I have to pay as a liquidator certain amount of money on behalf of the corporate debtor to a creditor on a future date, I should calculate the present value of that money today so that I will be able to meet the right value or at the right moment. So what is the regulation 28 saying? It says liquidator is required to discount the debt to its present value using an appropriate method, usually by applying a discount rate that reflects the time value of the money. So depending on the interest rate and appreciation of the money, the same rate is applied to discount the present value of the future money. So if I have to see how much my money becomes at the end of 3 years, I have to keep on adding interest to this money for a period of 3 years. So then the money appreciates at the end of 3 years. But if I have to do the opposite, if I have to understand the present value of the future money, then I have to do the opposite, that is discount that money with the same interest rate so that I will know what is the value of the money today. This is called the present value concept. Let's go forward. Regulation 28 also says that the discounted value of such debts is then considered when determining the total quantum of claims for distribution in the liquidation process. Now we move to Regulation 29 that talks about mutual credits and set off. There can be transactions where the corporate debtor has to pay certain money to a third party. At the same time, the third party also has to pay certain money to the corporate debtor. So what we are going to do is, we are going to adjust these mutual amounts payable, set off one against the other, and only look at what is the net amount payable by which party to the other party, right? So if the liability of the corporate debtor is more than the expected income from the third party, then after the set off, the corporate debtor will have to pay something more to the third party, which is a creditor. On the other hand, if the expected income from the third party is more than the expected expenditure to be incurred by the corporate debtor on account of a third party, then the corporate debtor will receive more from the third party, because after the set-offs, the corporate debtor will not have to pay anything to the other party. So this is how set-offs work. Let's read what is given in Regulation 29. If two parties, the corporate debtor and the creditor, owe each other debts, the liquidator considers the mutual credits between them. The liquidator allows for the set-off of the debts, meaning that if there are mutual claims, they can set off against each other. The net amount will be considered for the liquidation process. Moving forward, Regulation 29 has a third paragraph which says that the liquidator will calculate the difference between the mutual claims and only allow the net balance to be admitted as a claim, ensuring fairness in the liquidation process. This we have understood thoroughly. So let's proceed forward to Regulation 30. Regulation 30 speaks about verification of the claims. The liquidator must verify the claims submitted within 30 days from the last date for receipt of the claims. So usually when a public announcement is made, the liquidator can give certain time limit within which the claims can be made. After the last date for such claims is expired, then in the next 30 days, the liquidator shall verify these claims and come to a conclusion. So what is the conclusion? Conclusion can be either to admit or reject the claim. And this can be either in whole or in part, and we have read this several times, both in CIRP and after that in liquidation. We have read this in the Act and also in the regulations. So the claims collated during the CIRP but not submitted during the liquidation process must also be verified now within 30 days from the last date for receipt of claims during the liquidation process, so that we give a last chance to the creditors and they will not miss out any opportunity of encashing their claims. So liquidator has a duty not only to look into the claims made during the liquidation process, but also look into the claims made during the CIRP process so that he can conclude all the claims at one go. Regulation 30A. The moment I am using letters of English alphabet along with the section number, like the 30A, 31B, 33C, or whatever regulation numbers or section numbers, it is understood that these regulations are originally not there in the first set of regulations. These were inserted by way of a modification at the very relevant place. So we can't keep on adding regulations at the end of the series of regulations. Therefore, what we do is we bring the amendment, pick up the relevant regulations and add them right behind what is the sensible regulation. So when I'm talking about debts, claims, and then set-offs and related procedure, transfer of debt due to creditors will also be a relevant context. Hence, we have added this as 30A instead of maybe a 74 or a 75th regulation. So let's see what is 30A saying. It allows for the transfer of debt due to creditors from one entity or person to another during liquidation subject to certain conditions. Such a transfer must be approved by the liquidator and must align with the principles of the IBC. So what we are trying to say is, if there are two creditors, C1 and C2, C1 made a claim for 1 crore, C2 made a claim for 1 crore. So the total amount of money to be paid by the liquidator to C1 and C2 collectively is 2 crores, right? But individually, he should pay 1 crore to each of them. Let's say C2 owes 1 crore to C1. C2 owes 1 crore to C1. So C2 is saying that, boss, whatever money that I have to pay you, a similar amount of money is to be paid by the liquidator to me. So please collect the whole sum from the liquidator and relieve me from my liability. So in that case, if the C1 is agreeing to collect it from the liquidator, then C2 will transfer its debt to C1 and then C1 will collect the whole amount from the liquidator. So liquidator now will pay the entire 2 crores only to C1 instead of the earlier case of 1 crore each to C1 and C2. Hope this is very clear. Such a transfer must be approved by the liquidator. Remember, this is not a discretionary power of the creditor, but it should be approved by the liquidator because there has to be a lot more documentary evidence and it might put liquidator under serious confusion. Therefore, first take it to the liquidator. If he accepts it, only then your debt can be either transferred or aligned. Let's come to regulation 30A, the last paragraph, which says the transfer ensures that the creditor's rights to the debt are preserved, allowing the new party to pursue recovery or deal with the debt as per the liquidation proceedings. And hence, there will not be any fresh liability, but the same liability will now move to a new creditor or an older creditor. We come to regulation 31 that talks about list of stakeholders. See, until now we spoke about creditors who claim money from the corporate debtor, like financial creditor, operational creditor, employees, workmen, and other stakeholders. So now we are going to understand who all will be these other stakeholders. The liquidator has an obligation to prepare a list of these stakeholders. So regulation 31 says the liquidator shall prepare and maintain a list of stakeholders which includes all creditors and any other parties having a claim on the assets of the corporate debtor. The list must categorize stakeholders, including secured creditors, unsecured creditors, and other relevant entities which makes a claim. The list must be made available for public inspection, ensuring transparency in liquidation proceedings. So this is to ensure that if I am one of the stakeholder, let's say I am in a dispute with the corporate debtor on a certain property and I believe that the property should come to me. So I'm one of the stakeholder. Is my name at all there in the list maintained by the liquidator or not? I might have this doubt at every point of time. Hence, to give me an opportunity to check my name on the list, it is made available for inspection and generally kept at the corporate debtor's office or made available on a certain website. The liquidator is required to update the list periodically to reflect any modifications in the claims, including the admission or rejection of claims or any changes to the status of creditors. Now we move to Regulation 31A, which talks about Stakeholders Committee or Consultation Committee. The liquidator may constitute a Stakeholders Consultation Committee to consult with stakeholders and assist in the liquidation process. The committee may consist of representatives from creditors, employees, workmen, or all other stakeholders deemed appropriate by the liquidator. The committee is established to consult the liquidator or consult with the liquidator on matters related to liquidation. The liquidator shall consult with the committee on significant decisions in the liquidation process, but retains the ultimate authority to act, which we have read it multiple times in the past, that liquidator may consult, but that consultation is not binding on the liquidator. Hence, he is free to accept or not to accept the advice or recommendation given by the stakeholders committee. Regulation 32, one of the most important regulations, speaks about sale of assets. We need to understand why sale of assets is significant. Number one, the whole objective of the liquidation is to determine the amount of liability that the company owes to third parties, then sell off these assets and make payments to the creditors, and if there is any surplus, distribute that surplus to the shareholders. This is the whole purpose of the liquidation. While we are doing that, the question is, can it be done arbitrarily? Can the liquidator randomly sell these assets in any method to any party that he knows, maybe for a reason of bias or maybe for a reason of convenience? If he does so, this will defeat the provisions of the IBC. The provisions of the IBC clearly say that this is a process for a speedy recovery. This is a transparent process, and the whole process is aimed at maximizing the value for the creditors. Value of the asset should be maximized. So hence, how do you sell the assets of the company, corporate debtor, is an important question under the IBC to ensure transparency and to bring the better value. So the liquidator may choose the appropriate method for asset sale, such as auction, private treaty, or any other method that is in the best interest of the stakeholders, subject to the approval of the committee of creditors or the adjudicating authority. Before sale, the assets may be valued by an independent valuer. The evaluation report must be shared with the stakeholders to ensure transparency in the sale process, so that we know the machinery, plant, and land and buildings are collectively valued at 100 crores. Are you selling these properties at a lesser price or more price? If you are selling at a lesser price, then there is something fishy, and if you are selling at a better price, then it is a good news for the stakeholders. They are going to recover more money than what is anticipated. The liquidator shall ensure that the terms and conditions of the sale are clear, fair, and disclosed to all potential buyers. The liquidator may finalize the sale after ensuring it is in the best interest of the stakeholders, and sale must be either confirmed by the committee as well as adjudicating authority if required. So this brings us to the end of this session, and quickly summarizing what we have understood in this session, we understood how do we deal with the debts mentioned or denominated in a foreign currency, how do you deal with periodical payments under Regulation 27, how do you deal with the future debts under Regulation 28, and how to set off the mutual credits of the parties under Regulation 29, how do you verify claims under Regulation 30, transfer of debt under Regulation 30A, how to prepare a list of creditors under 31, and 31A speaks about Stakeholders Consultation Committee, and Regulation 32 speaks about the sale of assets of the company that we have read can be either by a private treaty or by a public auction. So this is a summary of the sessions of the day. We will meet soon in the next session with more information on IBBI regulations. Thank you so much.